Imagine you've just placed the winning bid on a prime property at auction. The hammer falls, and you have like exactly 14 days to hand over £1 million.
Which is stressful enough on its own.
Right. You call your high street bank, and they tell you they need 3 months just to process the compliance paperwork. Your deal is completely dead in the water.
Yeah, game over before it even starts.
Exactly. So welcome to today's deep dive. We are looking at a really fascinating piece of reporting from London Business News about the UK's bridging loans market. This is basically the exact financial mechanism built to bypass that bureaucratic gridlock. It crossed a historic 10 billion milestone last year, and it's now projected to hit a staggering 12.2 billion this year. Okay, let's unpack this. This market acts like a financial adrenaline shot right when traditional banks tap out.
It really does. I mean, to see a specialized short-term lending tool explode into a 12.2 billion market, well, it means something fundamental shifted in the traditional financial system. And the reporting actually traces this back to the 2008 financial crisis.
Right, the classic banks got strict after the crash narrative.
Exactly. But for anyone following finance, that idea is old news. The real catalyst is how their underwriting evolved. You see, traditional banks essentially became these algorithmic box tickers.
So they're like massive cargo ships, right? They take miles just to turn around. So how did these bridging lenders manage to act as the speedboats filling that massive void?
Well, when high street banks abandoned manual, nuanced risk assessment, the computer just started saying no to anything unconventional. Say a property was dilapidated and technically unmortgageable because it lacked a working kitchen. Or maybe the borrower had complex self-employed income.
The traditional banks just wouldn't touch it.
Exactly. They stopped looking at the underlying asset's potential. But bridging lenders realized that an unconventional property isn't inherently risky, if you understand its true market value.
So they established themselves as a really credible alternative by completely ditching the standard checklist.
Right. They stepped into the vacuum by replacing the bank's algorithmic checklist with pure asset-based underwriting. They aren't fixated on your monthly salary to see if you can survive a 25-year mortgage term.
Which makes sense for short-term loans.
Yeah, they are looking heavily at the property itself and your specific exit strategy, meaning like exactly how you plan to pay them back quickly, usually by selling refurbished property or refinancing it.
Which really explains the sheer velocity of this capital. The article notes firms like Octagon Capital and Maslow Capital, they are deploying funds in weeks, sometimes even days.
It's incredibly fast.
And it's driven by a highly concentrated ecosystem. There are fewer than 100 lenders in the UK doing this. But the sources also credit thousands of intermediaries for making this work. How do brokers actually speed up the machinery so much?
So the intermediaries basically act as the translation layer between the borrower and the lender. A specialist broker pre-packages the entire application.
Oh, so they do the heavy lifting up front.
Exactly. They ensure the independent valuation, the legal framework, and that crucial exit strategy are completely bulletproof before the lender even opens the file.
Wow. So by the time the lender sees the deal, the risk has already been rigorously modeled. That must cut out weeks of back and forth.
It cuts out all the friction, yeah.
But wait, I have to ask, if they aren't using traditional affordability rules, isn't that incredibly risky? Bypassing standard income checks sounds like playing with fire. If a lender isn't verifying a borrower's monthly cash flow, how does that not spiral into a massive subprime-style default trap if the housing market suddenly dips?
That's a really valid question, but it doesn't happen because the leverage is aggressively managed. Bridging lenders protect themselves by strictly limiting the loan-to-value ratio.
Okay, so they aren't lending 100% of the money.
Not even close. They might only lend 60 or 70% of the property's current value, and that creates a massive equity buffer.
Right, so if the market dips and the borrower's exit strategy fails, the lender can just repossess and sell the asset quickly without taking a loss.
You got it. The primary safety net isn't the borrower's ongoing income, it's the hard equity sitting right there in the brick and mortar.
Okay, that makes perfect sense for a professional developer flipping a warehouse. But people are also using these loans to, save their personal residential property chains from collapsing or to buy a new family home before selling their old one.
Yeah, they absolutely are.
You absolutely cannot have everyday consumers losing their primary homes just because they misunderstood a highly leveraged short-term loan.
Which brings us to the guardrails. And honestly, the market structure here is actually quite elegant. The bridging market is split almost exactly 50-50.
Oh, really? How does that work?
So half of it is strictly regulated by the Financial Conduct Authority, the FCA. Those regulations kick in the exact second a loan touches a borrower's main residence.
So everyday consumers are protected.
Exactly. The FCA mandates rigorous stress tests and transparent fee disclosures to ensure consumers aren't trapped in these debt spirals.
And the unregulated 50% is just left to the open market.
Yes, because that half is strictly ring-fenced for commercial and professional investment. I mean, a seasoned property developer doesn't need heavy-handed consumer protection. They need friction-free capital to get a project moving.
Right. The lack of FCA regulation on the commercial side allows lenders to structure those highly bespoke deals that a rigid regulatory framework would otherwise choke.
Exactly. It perfectly balances safety for consumers with speed for professionals.
It completely recontextualizes the real estate market right in front of us. So for you listening, the next time you see a commercial high street refurbishment happen at breakneck speed, or a derelict house snacked up and transformed in a matter of months, you aren't just looking at fast construction. You're looking at this exact 12 billion pound bridging engine in action.
Yeah, it's that agility that traditional banking just engineered right out of its own system.
Which leaves a really fascinating question to chew on. If a 12 billion pound industry carved out a permanent home simply because traditional banks became, too rigid and algorithmic to handle bespoke property deals, well, what other massive standardized banking sectors are currently out there, just right to be replaced by faster, specialized alternatives?